Welcome back to Startup Essentials, brought to you by Carta. In this episode, we're going to talk about one of the first and most common questions you're likely to hear from potential investors in your startup, which is, what's the size of the market? Knowing how to think about market sizing is super important, not just for building your product roadmap, but for all of the various aspects of growing your business, especially fundraising. So over the next few minutes, we're going to learn all about market sizing, what it is, how you can calculate it using things like TAM, SAM, and SOM, top-down versus bottom-up approaches, and perhaps most importantly for you, what VCs are going to be looking for when you talk to them about these calculations. But before we get started, if you do find this kind of startup education content useful and want to see more of it, do feel free to calculate the market size of the like button. Hit subscribe, tap the little bell for notifications. It's helpful for us here at Carta to understand what kind of content's useful to you so that we can continue making more of it. And with that out of the way, let's do this thing. This is market sizing for founders. So quick pro tip, on the Carta website, we do have a free market sizing guide that helps walk you step by step through different scenarios and provide helpful tips. So if you need help determining your market size and you want to use it, hit the link in the description down below and you can download the tool. It's totally free. And with that said, let's start by laying some foundation. What exactly is market size and why should you care about it in the first place? In a nutshell, market size is the total potential for revenue in a specific market. It's essentially a number that's based on a few different things, namely the total amount of customers that you could possibly have in this market based on a bunch of details like spending trends and historical sales in that market, etc. To put that in really simple terms, basically just think of market size as the upper limit of your company's total revenue potential. And if you're thinking what I think you're thinking, yes, you can probably imagine it's a pretty important number to investors. They use your market size to assess the potential return that they could get on their investment in you. Essentially, they take the market size and compare it to the amount of ownership they'd be purchasing in your company, along with the total value that the company might have when you eventually exit. So, okay, we know what market size is, right? But the real question is, how do you calculate it? So let's talk about that. Perhaps unsurprisingly, there are a number of different things that go into calculating market size. The main things you're going to want to look for are the number of potential customers that you could have, the average revenue per customer, the percent of the market that you think you can realistically capture, and the growth rate of the actual market itself, which probably sounds like a whole bunch of stuff that you don't know yet, right? So to help you figure that stuff out, there are three types of markets that you're going to want to understand before you get started. They are the total addressable market, or TAM, the serviceable addressable market, or SAM, and the serviceable obtainable market, or SOM. In combination, these three things are going to help you get a sense of your overall market size. So let's break each one of them down, starting with the first one, the total addressable market. TAM is the first big number you're going to want to know. It represents the total demand for your product across all the potential customers that you could conceivably have in the known universe. Calculating TAM is pretty simple. You're just going to want to follow a few key steps. First, you're going to want to define the target market. This is your base number, and it's purposely really big. It can be anything from the total population of a specific city all the way to the total number of businesses in an entire country. From there, you're going to want to whittle that number down into a realistic potential customer base. You'll do that using data about prospective and existing customers in your industry. Finally, you're going to want to estimate the potential spend per customer. For example, here at Carta, we use the average annual contract value, or AACV. So to figure out your company's TAM, you just follow a basic equation. Your TAM is the number of potential customers you could potentially have in a realistic universe, times the amount of money that each of those customers could potentially spend. Let's look at an example. Let's say you have a product that's for public schools in the United States. You'd start with your base number, the total number of schools in the entire country, which, let's say for the sake of example, is approximately 100,000 schools. You then determine that about 10% of those schools would be interested in buying your product. So 10,000. So your potential customer base would be 10,000 US public schools. Okay, so we've got the first part of our question. Now let's work on the second part. For ease of math, let's say on average, you expect each one of those customers to spend $1,000 on your product every year. So simple equation, 10,000 total customers times $1,000 per customer gives you a total addressable market of $10 million a year. Voila, you've found your TAM. TAM is an important metric to investors because in addition to estimating the total market potential, it's a good measure of the potential for your company's growth in the future. So when you think TAM, think growth potential. Okay, so you found the big number, the TAM, which is the total size of the whole market that you could realistically capture. But then you got to consider, if there are competitors out there or weird regulations that make certain portions of the total market harder to reach, et cetera, you're going to only be able to service realistically a certain portion of that market. And that's where SAM comes in, the Serviceable Addressable Market. In calculating this, you're basically determining what percentage of the total market, or TAM, you can realistically expect to reach with marketing and sales efforts. This depends on a whole bunch of factors like brand recognition, pricing, competitive advantage against other companies in your space, and so on. So if we continue with the same example from before, we've got 10,000 total schools in our TAM, right? But let's say each county in the country has different tax rates or something, and those tax rates affect a school's ability to spend money on a product like yours. Given these weird tax differences, you might only be able to assume 1% of those schools would actually pass that threshold and fit the criteria to purchase your product in the first place. So, easy math, 1% of 10,000 is 100 schools. And this is your serviceable addressable market, or in other words, the portion of your TAM that you could realistically get to. All considered, SAM is an important metric to you because it helps you estimate practical targets for all sorts of important stuff like revenue. So again, to recap, TAM helps you estimate growth, while SAM helps you set practical targets and milestones in the now. And finally, there's the Serviceable Obtainable Market, or SOM. This one's a lot simpler, so to explain it, let's look back at our funnel really quick. At the top of the funnel, we've got our total addressable market, right? This was 10,000 schools all over the country. Then, of that TAM, we've whittled down to our Serviceable Addressable Market, which is 1% of the TAM, or 100 schools. And finally, from there, we want to figure out, okay, of that SAM, how many of those 100 schools are we able to capture right now based on the resources that we have available today? This is your Serviceable Obtainable Market, or SOM. It's the portion of your SAM that you can currently capture with available resources. So let's do some quick math. Say your SAM is 100 schools, and with the resources you have right now, you can realistically capture 10% of them. This leaves you with 10 schools. So if we divide this number, 10, by the total TAM, which is 10,000, that leaves us with a SOM of 0.1%. Okay, so we know what TAM, SAM, and SOM are at a high level, but now the question becomes, what are the methods that we can use to figure these numbers out? In general, there are two approaches to running these market sizing calculations, top-down and bottom-up. So let's explore them both, starting with that first one, the top-down approach. The big thing to know about top-down market sizing is that it's often the quickest way to work, but it can be a little less reliable because it essentially depends on estimates, which means you'll want to use it when there's not a lot of hard data available and you need to make quick assumptions. Here's how it works. You're going to start at the top, the TAM. So this means you're going to essentially identify the broad industry that you're serving or want to serve. Then you're going to drill down into the specific niche or geographic area that you want to target within that industry. So this is your SAM. And finally, you'll identify the percentage of your SAM that you think you can realistically capture. This is your SOM. So you get the idea. Top-down market sizing starts at the high level with the industry and then drills down into specific niches you can service and capture. Bottom-up market sizing is basically the opposite. The big thing to know is that it tends to be a lot more time-consuming, but because it's based on hard data, this method tends to provide more accurate results. In the bottom-up approach, you're going to start with your SOM, which means identifying the number of customers that you're currently serving, or at least the ones that you can currently serve. Then you're going to analyze how those companies can be collected together into unique industry segments and work your way up to determining the actual size of those segments in general. This is your SAM. And then finally, you're going to calculate the potential revenue that you'll earn if every single customer in the entire target segment goes ahead and uses your product, which would be your TAM. Overall, in the bottom-up approach, you're going to use hard data like historical sales, surveys, or even competitor pricing to calculate your market's potential size at a more numerically accurate level. So like I said before, it tends to be a little more time-consuming than the top-down approach. Okay, so it's time for the big ultimate question. When you're talking to VCs, What are they looking for, and why do they care about TAM, SAM, and SOM calculations? The simple way of explaining it is they're taking a calculated risk by giving you money, and so they want to make sure that the upside associated with that risk is appropriate and proportionate. In general, a good rule of thumb is VCs like to see that you have a TAM of at least $1 billion. But that said, it's not enough to just target a huge market, right? Investors are also going to want to see that you have a realistic plan for capturing a significant portion of that market. So your SAM is going to show them how well you understand the dynamics of the market you're going after. And finally, your SOM is more of a hard projection in the near term. Typically, it tells VCs your 3 to 5 year revenue projections, which they then do a bunch of fancy math with in order to make sure that they're making an informed investment. At the end of the day, calculating market size can be as helpful for you as it is for VCs. Knowing the size of your TAM can not only help you set clear goals for the future, but also budget realistically in order to hit them. And that's it, the basics of market sizing. If you found this video useful and you want to keep seeing more startup education content like it, we do encourage you to like, subscribe, hit the little bell for notifications, and we'll see you next time on Startup Essentials by Carta.